Well, welcome to the Council on Foreign Relations for this World Economic Update with Professor Takatoshi Ito of Tokyo University, Louis Alexander from Norma, and Vincent Reinhardt from Morgan Stanley. I'm bidded to tell you that the next meeting at the CFR is a 12:30 meeting, or the next general meeting, about driverless cars. And I'd like to, we do everything here, from the world economy to driverless cars. You could argue that the world economy is a driverless car. And I'd also like to welcome the CFR members around the nation and the world participating in this meeting through live stream. So I've got, as usual, some questions about the big major economies in the world, and we'll go around that. But I want to get two things on the table first before we get there, just because they're in the news. And the first is Ukraine. And so I want to go down the line here and basically ask, okay, we've got a country which has got internal political uncertainty, and we've also got external donor uncertainty in that we've got certain officials in other countries either saying they're not going to give any money or they will, but then when you actually look at it, it doesn't turn out that maybe Congress has authorized the money they're promising. So the question is, in the next 6 months or so, is Ukraine likely to default? Taka.
Well, I'm not a Ukraine watcher, so all my judgment comes from all I read in newspaper, and I talk to people in Washington. And the simple answer is yes, and it doesn't seem to be the situation that there is a responsible government in Ukraine to negotiate the necessary terms of the rescheduling. So
Okay, Louis.
Yes, in some sense I think they already have, in the sense that they're already accumulating arrears on various things. I mean, government finance in this environment is going to break down, and I think it's pretty much inevitable.
Yes, as long as you define default generously enough. It could be a technical default because there isn't a government there. It could be some write-down of the bank debts before the government accumulates them, or it could be sovereign.
Well, we can come back to that in questions later. The second thing I want to get on the table is Bitcoin. Through history, money has either been some scarce metal, the supply of which can't be manipulated very easily, or it's been government-backed paper, where the idea is that at least you've got the coercive power to tax behind it. Bitcoin is neither a fixed metal, nor is it backed by any government. Is it therefore as irrational as tulips? Taka.
the Bitcoin's supposedly invented by a Japanese, so
but not you.
not
No,
me.
no.
So I profoundly apologize for creating such a bubble, but I think it's a bubble.
Okay.
I agree it's a bubble. The one thing I would say is I think there are going to be lots of different ways of carrying out payments, and one of the things you've seen consistently is innovation in means of making payments. I don't think we should, the fact that Bitcoin is like tulips should obscure that fact.
I mean, tulip is the right analogy because it's a private sector medium, and it's similar in other ways as well.
Okay, good. So we have 2.5 votes for tulips. Right, so now let's get to the big economies. We're going to start with the US. I guess if we'd met 3 weeks ago or so, the conversation would have been dominated by collapsing global markets. That's stabilized somewhat. But if we look at the numbers on the real economy, Vincent, you and your team at Morgan Stanley have been revising Q1 down a lot, I think from 2.3% growth to 0.7%. Part of that is weather, but is it mainly weather, or is there something else going on?
Yeah, there's a deep frustration. Not only do I have to live through the weather, I then have to go explain it after the fact. And our forecast, stepping back, was that the economy had been stuck in a 2% channel. It would pick up to 2.75%. Some slowing relative to what initially printed for the fourth quarter as a pretty torrid pace of domestic private spending was expected. we are not just a data observer, we're a data collector. We have an effort to produce a contemporaneous reading of activity, so we have a lot of regional information. The regional inputs to our monthly indicator did line up with bad weather, with shipping delays, with degree days and all the like. So that does make us think it is importantly weather. The data softened even underneath that. So the basic picture is the economic landscape is frozen over. It's not going to thaw for another month and a half till we get a sense of what underlying momentum is. We think it is mostly weather, but you have to leave open the possibility there's a little more slowing than that.
Okay, so Lewis, I think you've written recently that depending on which measurement you use, the US economy is either operating at full capacity of employment or way below capacity. Can you explain why this is a particularly difficult moment to judge what the potential is and what that means for the new Fed chairwoman?
Sure. If you look at the performance of the labor market, there are two broad themes that are very anomalous relative to other recoveries. One is the number of people that have actually dropped out of the labor force, so this is the problem of labor force participation. The other problem is the fact that the level of long-term unemployment, so the ratio of people who are unemployed for more than 26 weeks relative to shorter-term unemployment, is very different than it's been in past cycles. What you think about the significance of those two groups is a very important issue. If you argue that those two groups are not relevant for inflation, which I would argue the data is increasingly pointing to, that suggests that the Fed does not have a lot of room to let the economy run without generating additional inflationary pressures. That's obviously a very difficult position for the Fed to be in. And the question of can you draw people out of those two groups into employment more rapidly is a crucial question. I think the problem is the data and the analysis is increasingly pointing to that is a very big challenge. And I think it puts the Fed in a very difficult position. Obviously, it's a tremendous problem, the fact that you have this long-term unemployment and these people have dropped out. You want to try and have policies that can address it. The problem is it's not clear that monetary policy is really the tool that can address it.
Taka, you, in Japan, I think you're known as the leading inflation targeter, or one of them. And you've been critical of a central bank in the past, which has underestimated its power. Listening to the debate here in the US, do you feel as if people are too timid about the power of monetary policy or appropriately?
No, I think it's appropriate. And what's interesting to me is the use of the dual mandate to their advantage, right? So we used to think that inflation targeting is a single mandate thing which U.S. cannot subscribe to, but U.S. did adopt inflation targeting in January 2012, and I think that was a bold step. But at the time, I think there was recognition that having the full employment is actually will help to drive the monetary policy to continue stimulating the economy. So using two sort of indicators, not target, but the indicators to get the economy going, even if the inflation rate is too low or may overshoot, whatever. But I think the use of the dual mandate, I thought was brilliant.
Brilliant, Vincent?
So I think 2014 is going to be a conversation about aggregate supply. How big was the level loss to aggregate supply associated with having the severe financial crisis and then subpar economic recovery? And then what's happened to the rate of growth of potential output? The first, how big the gap is, depends on the Federal Reserve's tactical position, how much stimulus they need to get back to full employment. The second one, the rate of growth of output, determines the resting point. How high is the equilibrium real interest rate? And I think the conversation, unfortunately, is going to turn out to be dark. There was a level loss associated with financial crisis and subsequent economic performance. And then every way you add it up, it seems like potential output growth is slower. We shouldn't forget the consequence of the latter, though, which is it means probably the equilibrium real short rate is also supposed to be lower. So we've rotated the path of future output, which is bad in terms of the net present value of wealth, but we also lowered the discount rate to it.
But,
Right.
and you're gone, yeah.
I just want to add one thing. I very much agree with all of that. There's just one additional point, which is there's also a question of the degree to which you can reverse some of those losses by running high pressure policies going forward. The judgments you make about that question are also going to be important because people have made the argument that if you can reverse them, that is a reason to, in some sense, continue to push on. Again, I think the conclusion of the research that's coming out, that's all sort of micro-driven on the labor markets, is very pessimistic on that as well. And so that argument doesn't get you out of the dilemma.
But let me just ask one more question about, maybe for anyone, about US monetary policy. So there's a debate about output and potential, but there's also the fact that inflation is still below target. And yet the Fed is on this tapering course and appears to be fixed on this tapering course, but is that because the sense of the efficacy of continued QE has declined, and therefore, even if you might ideally want more stimulus, you just don't think you'll get it in a good cost-benefit way?
So I believe it's a judgment about the efficacy of the stimulus rather than an overall view on how much stimulus is required. That most things in life have diminishing marginal return. QE purchases probably do as well. That you worry about the pockets of excess associated with taking out duration from markets. That there was the judgment that the main accomplishment now of QE is sending a signal, and that signal can be achieved more reliably by forward interest rate guidance. There's a problem, though, about central banks. Central banks love optionality. You never want to discredit an instrument that you may need at a future date. And so there's a certain insincerity about the Fed's communication about QE, that it was more about the economy. We didn't have to worry about the low level of inflation, so we can exit from QE. I don't think they viewed it as lessening accommodation. I think they viewed it more as relying on the form of accommodation that works in the models they tend to focus on.
Mm-hmm.
Yeah, just one additional thing. I do think part of the concern about QE was the impact on systemic risk. And I think while that debate has been played in the past as something related to asset purchases, I think increasingly the question of does the whole rate structure generate those problems as well is going to become a new issue. And I think in some sense many of the same concerns that they had about QE I think are going to be translated over to the whole structure of rates. And so while these aggregate demand, aggregate supply arguments are sort of central to this, I think there's going to be another set of concerns that they're going to have to deal with. I personally think we don't face material issues on systemic risks and that should be a constraint on policy. But I think that is where the debate is going. There are clearly people on the committee who are concerned about it. And so that's going to be a whole nother issue that I think we're going to deal with over the next 6 to 12 to 18 months.
But to Taka's point about the Fed and inflation goal, inflation is below goal. Inflation in the U.S. is pretty inertial. The force of slack on inflation is pretty weak. Although I think the important conversation is about aggregate supply for 2014, Janet Yellen doesn't have to mention the unemployment rate in 2014 to accomplish an accommodative policy, because the low starting level of inflation provides enough justification in and of itself.
Yeah.
Yeah. I think there is a difference between QE1 and QE2 and QE2 and QE3. And QE3 is like QE1, and it targets the long end of the interest rate, especially on the mortgage rate. And this has been a success because it stimulates the housing demand, and housing price has been stabilized and going up more recently. So in that sense, supporting that sector has been a huge success, and whether that spills over to the rest of the economy is a question, and I think it's spilling over.
Well, I mean, the most aggressive QE experiment right now is actually now in Japan, I think.
Mm-hmm.
You've advised Prime Minister Abe in this incarnation, and then also in the previous time he was Prime Minister. Talk about, first of all, the monetary part of Abenomics. Some people call it Kudodenomics. Is that going to plan, or is there a risk that the growth numbers are now slowing? You had a big bump initially, a big effect initially. Now it's slowing down. Are you worried with the consumption tax hike coming in April that the central bank, which has looked like Superman last year, won't look so great in 2014?
Yeah. So monetary policy was called the first arrow of the Abenomics, and I would say it was huge success. So it completely changed from deflationary defeatism central bank to proactive inflation targeter, and that market welcomed it, and yen depreciated by 20%, and stock prices increased by 60 to 70% in the period of mid-November 2012 to May 2013, when the taper tantrum started. So then it's plateaued since then, and now some people are calling for the additional precautionary easing of the monetary policy. It may come, it may not come, depending on the economic forecasts of this year. But I think on the whole, the first arrow, the monetary policy, has been huge success.
This precautionary, that means a second wave of sort of accelerated.
Right, so the growth number of last quarter was not that good. And consumption tax, which is a VAT, tax rate hike is coming on April 1 in 6 weeks. And people worry that this VAT hike from 5% to 8% may slow down the growth substantially. I don't think it is going to be substantial decline. So that's sort of the debate.
But if it was a substantial decline, you're saying the central bank has the option of accelerating. It's already said it would double the balance sheet.
Yeah.
It might do even more than that.
Correct. So Mr. Kuroda has been very clear that if needed to achieve 2%, he's ready to do additional actions.
One more question for you, and then I want to have Vincent and Lewis comment on the same thing. So if we're in a world where the central bank already says it will double the balance sheet, and that in fact it might do more if it's necessary to reach this 2% inflation target, what are the risks of something disorderly happening? I mean, in this country we had a debate about whether QE would be destabilizing. To some extent we're hearing that we're backing off from QE before we reach the inflation target in the US because of some worry about systemic risk. What about Japan? You've got this enormous government debt. The system is just being stimulated as much as one can imagine by money. Is there a risk either for the currency, for the debt?
Well, then we have to look at Abenomics in totality. So it has aggressive monetary policy, first arrow, and flexible fiscal policy as the second arrow, and the growth policy as the third arrow. So first arrow sets the stage, and second arrow pushed in the beginning with a monetary policy to get out from the deflationary mind to a growth path, which was a huge success in last year. But with those setting the stage, the second arrow started to bend to consolidation, and they confirmed that already planned tax increase will take place. So the fiscal is going to be more consolidation, and monetary is still stimulus. So it's a policy mix of that kind. And in the meantime, the growth policy is supposed to come and push all the potential growth rate to go up in time to support the slight consolidation of the fiscal part. Fiscal consolidation is needed to have the sustainability back. So how to get that tax revenues without getting economy to go down? So that's the first arrow and third arrow to support.
The third arrow being the structural reforms, and you need that to come in. And yet, examples of structural reforms actually having been adopted are hard to point to so far, right? There's discussion, but not.
Yeah, it seems very slow, and I do admit that it seems too slow. But there are small concrete steps like abolishing the rice paddy production quota, and
That's happened. That's not just
that
a-
happened.
Okay,
That
yeah,
happened.
yeah.
And also there is a concrete steps to reform the government pension fund that has a huge impact on the capital markets. So there are small measures. So it's people say it's not big one arrow, but 100 daggers.
Lewis, do you worry that this whole process could come unstuck somehow? Is there a risk in instability?
Look, I don't think there's any question that the degree of difficulty here is very high. I mean, when you look at the fiscal sustainability, you look at how weak growth has been over the years, it's just a big challenge. I think the obvious thing you would worry about is if you've got higher rates and not higher nominal growth, right? Ordinarily, you would think those things would go together. Say, for example, if inflation expectations were actually to build, that should be, in some sense, be reflected both in interest rates but also in nominal growth, which would raise the tax base and generate that. If you don't get those two things together, that's the sort of nightmare scenario. Now, I think they have a lot of means to control, and I think, as Professor has indicated, the first arrow has been very successful. I think the second arrow, the fiscal consolidation, is sort of on track. And their question is, can they really deliver growth, both in real terms and the sort of the nominal growth that would come with that? I'm optimistic, but there are clearly risks.
Yeah. So this is a great experiment in monetary economics. We've had a central bank that for 2 decades said it wanted to generate inflation, now has an administration willing to tolerate the currency depreciation that's going to help that process along. The thing to remember is a central bank actually doesn't create extra output, it shifts demand. It can pull demand from the future intertemporally by keeping interest rates low. It could pull it from abroad internationally by keeping its currency low. If the third arrow is not success, there really isn't any extra output to bring forward, and that will be associated with slow growth. If the US isn't successful in continuing to grow, one worries about the political process and the tolerance of a weaker yen internationally. That's a real risk. As for the orderliness of the process of quantitative easing, it really depends on remember, what the central bank is doing is taking duration out of the hands of the public and putting it on its own balance sheet. What do those former holders of JGBs do with the resources? To the extent that they turn and invest it in domestic equity, you can have the wealth creation and the support, the capital spending and consumption generally, that it works. The problem comes the day that it turns entirely to the external sector because of questions about the fiscal sustainability and domestic conditions. Doesn't seem like that's
So you mean Mrs. Watanabe gives up her JGB, she turns around, she goes buys equities outside, the yen weakens more than you want.
And questions about the fiscal position then come into play. But to the extent that they turn and buy domestic equity and domestic credit, that's actually supportive of the domestic economy.
Yes, so people have been putting money into deposits. And that has been a huge success because deposit paying 0 interest rate, but the prices are dropping at 1%. So real return was 1%, while someone who invested in equities, they have lost huge. So there's a mind among the Japanese investors that deposits are safe and stocks are losing proposition. So we have to change this perception. So it's a we need to jump from bad equilibrium to good equilibrium. You cannot do the piecemeal thing to push the equilibrium position. So it's not only monetary policy, but those capital markets reform, and we introduced a so-called NISA account, which is after tax income you invest in the stock market, then for 5 years, you're exempt from the capital gains and dividend.
Well, perhaps you can remind your countrymen that in this country, the death of equities was the cover story on a business magazine in 1979. And for the next 20 years, US equities did rather well. So these things can turn around. Let me get to Europe a little bit just before we go to questions. Another country that, or another zone that's potentially debating these threats of deflation. The good news in Europe is we do have now some growth, modest, but it's there. The bad news is that if you just take Italy, you've still got youth unemployment of 40%, government debt to GDP at 130%. If Italy goes down the tubes, the whole Eurozone does, and so it's hard to argue that we're out of the woods. So the question for you, I want to ask Vincent maybe first, is should we worry about, you've got all this debt, if you combine that with deflation, you're in real trouble. German wage numbers seem to be very, very soft. The theory of the case a year ago, I think when we were debating this, was, look, you get a little bit of inflation in Germany, you keep it down to sort of zero in the periphery becomes more competitive, and that's the way you work your way out of this thing. Now German wages are not cooperating with that picture, and you're in this sort of dodgy equilibrium. Is this, are we going to be back in a crisis in a few months?
The basic issue being you need internal adjustment. It's an effective currency union, so you have to have relative prices shifting underneath that. If German inflation sets the high water mark and it is low, it just means that you're going to run into the problems of cutting wages outright, cutting prices outright, which is more difficult. Uncharacteristically optimistic, there has been some internal adjustment. Spain and Ireland are doing better, starting from a very low level, but the delta is a clearer sign. When you look back, the amount of resources governments have been willing to commit to the Euro project actually is pretty amazing. And so there is an ongoing existential threat, i.e. there's always the possibility a coalition breaks down or a weekend vote turns out to be different than the authorities are willing. There is, but the ECB's chief advantage, in some sense similar to Japan, what kills you when you have a currency crisis is capital flight. But capital flight is internal to Europe. And as long as they're willing to allow large conditional transfers in the form of target 2 imbalances, they can contain the pressure. So I would characterize it not as a situation necessarily likely to get worse. Muddle through seems to be the best bet, with a slightly positive incline, an opportunity for the ECB to use conventional policy, and an ongoing existential threat because politicians haven't really defined where they want the euro to be.
Sorry, the ECB will use conventional policy with respect to the deflation threat, but they're at the zero bound, right, pretty much?
They're not quite there yet, so they still have some conventional easing to do.
A quarter point, is it? Okay, Lewis.
Yeah, when I hear conventional policy in this environment, I think of forward guidance and asset purchases. We're kind of in a new world in that respect. Look, I basically agree with Vince in the sense that I don't think this is an acute issue. Frankly, one of the advantages of being in a world where inflation is pretty well anchored is it doesn't go up or down very quickly in either case. And so I think the risk of getting into a true deflationary cycle in Europe is not all that large. The two big surprises have been the fact that the ECB has been as successful as they have been at sort of stabilizing the financial side with what were, to be perfectly frank, kind of amorphous commitments. The other surprise has frankly been that the politics has sustained what has been a very costly real adjustment. So I think there was always this skepticism about how much internal adjustment you could get without the exchange rate and what was consistent with the politics. And the surprise has been they've been willing to live with more pain in some sense than you would have expected. I don't see those things turning around. I do think the ECB has room to do more. I'm puzzled why they haven't done more. I think they would obviously benefit from a weaker exchange rate if they could figure out how to get that. But I don't think we're likely to be back in crisis anytime soon.
Taka, people often compare Europe now to Japan in the 90s, and they see, do you think that's a relevant lesson?
Yeah, so when the Eurozone inflation rate has been coming down, people talk about Europe turning Japanese, right? So it's going down to deflationary path. I think the probability is low because I think the ECB, I would say even ECB has learned the danger of the getting into deflation. So I'm sure that before it hits a negative territory, they will change their policy and maybe go to zero interest rate or even the QEs. So the probability is low, but the possibility is there, and they should be aware that that's a territory that they do not want to go into because we had this 15-year of deflation in Japan. It was pain.
I
Okay,
would just
yeah.
underscore just the stability of the system, the fact,
Right.
you know, I'm ashamed to admit this, but 4 years ago I wrote something for I think it's called Foreign Policy, I guess, editor, and said this is amazing. This isn't just an economic crisis. It is a security crisis. You cannot have youth unemployment rates this high. You can't remember that the job losers are usually the ones who just first got jobs. That means there's an immigration issue. This is a large continent with open borders. It could go out tomorrow doubling the numbers. And there hasn't been hasn't been the political tensions. And instead, governments in the rich countries have committed an enormous amount of resources to the project.
So optimism on Europe. Let's now go to members.
Lack of
I'm not sure that was
sorry,
optimism.
Lack of pessimism.
Well, relative to your baseline 4 years ago. Perhaps I misunderstood. So I'd like to get questions from members. So remember, this is on the record, and if I can see a question right over there, wait for the microphone, please, and stand and identify yourself.
Thank you. We've talked quite a bit about.
Yeah, can you just say name and
Earl Carr. We've talked a bit about monetary policy here in the United States, and there seems to be quite a bit of controversy. There are those who feel that the Fed's quantitative easing policy has been quite a success. I believe, Professor, you mentioned that quantitative easing, particularly QE3, has been successful, particularly in looking at mortgage rates. However, there are those who also believe that the key benefactors of quantitative easing has really been the private sector, in particular banks. So I'm curious from the panelists, who have the real benefactors been of quantitative easing?
I mean, I think this is a general problem with monetary policy in general. It's to a certain extent, monetary policy works broadly through risk appetite. And there's a very important channel for monetary policy always, which is the value of financial assets. Obviously, financial assets are not distributed evenly throughout the economy, and that has, in some sense, a distributional consequence. But I don't think it's not as though there's some clear alternative. It's not like you could have stimulated the economy in some way that didn't involve that. And so I think you have to acknowledge that, yes, if you're operating through the value of financial assets, you will inevitably have a distributional consequence. But that's not to say that we aren't better off for having done it, because had we not done it, the economy would have been worse off, fewer people would have had jobs, labor incomes would have been lower. And so in some ways, I struggle a little bit with that question, in part because it's not obvious to me that there was another way to have done it. And so I acknowledge the issue, but I don't think that's an argument for not having done it, if I may put it that way.
another question? Yes, right here, please.
Ed Cox, Republican State Party. With respect to the labor participation rate, on a macro level, how much is it a matter of demographics? And on micro level of our job training programs as opposed to those in Germany, for example?
There clearly is a big element that's demographics. It's simply the fact that the baby boom generation is aging. So baby boom generation are people born between 46 and 64. The peak birth year is 56. So you can think of there being this front wave that's sort of moving through the age group. If you were born in 46, you're kind of 68 now. If you were born in 56, you're 58 now. So those people are moving into the age when they're going to be falling out of the labor force. So That is part of what's going on, but it's clearly only part of it. I don't think there's a simple explanation for it. If you actually look at our experience, it's quite similar to what European countries went through. So for example, the deep recessions the European economies had in the 90s and whatnot also generated big declines in labor force participation. I don't think there's an easy, obvious answer. One of the puzzles about this recovery is the fact that hiring remains very depressed. And I don't think there's an easy explanation for that story. Look, there's no question that other countries do active labor market policies better than we do in some aggregate sense. I think that's absolutely right. I think it's really hard to know how much of this you can explain that way.
Yeah, so just controlling for demographics, we can account for probably a third of the decline in the labor force participation. The other third, that 2/3, that doesn't mean it's all cyclical. There is probably some cyclicality to it, but you also have to think about things like returns to skills. Because of globalization and technological progress, those who have high skills are getting higher rewards. Those who have low skills are getting lower rewards. That means that when you think about age cohorts, young people have to stay in school longer to learn those skills. And if they don't have the opportunity to learn those skills, they think about the informal sector. Older people, if they had those skills, can retire earlier, or if they don't have those skills, look more favorably toward government entitlements. And that is probably part of the that 2/3 that are not secular. It's a challenge because there's nothing monetary policy can do for the portion of workers who are leaving because they're getting older or they don't see a return to staying in the economy. It's not obvious exactly what we can do because the record of job training programs is uneven,
Yeah.
to put it mildly.
Let's have a question right over there. So, okay, I'll come to you right after.
Thank you. Mike Hoden. On this demographic point, as certainly our Japanese friend will understand, the aging of the population is as much a function of the low birth rates. And as you know, Japan will soon have 40% of its population over 60. The OECD is starting to look at the aging population as a source of economic growth. So contrary to your point, sir, isn't one of the structural questions, how do we keep people healthy and therefore active and working beyond 60? The 20th century notion of retirement simply cannot work structurally.
You can keep the
And in
microphone.
Japan, you are beginning to look at the silver economy, as are several of the European countries, including Italy.
Please just pass the microphone to your right. Okay, for the next question, yeah. So go ahead.
Yeah, so you are right that we are emphasizing to keep the labor participation high for aged and also for women, because we have the huge gap in labor participation for the women in the childbearing and caring years. So those are two groups, about to retire and women as the source of the keeping the labor force higher than otherwise. And I think the Japanese elderly are willing to work and healthy enough to work, most of us, and I think that is a forced retirement in Japanese universities and bureaucracy at the age 65. I think that should be raised. But
You're arguing that for the good of the country, in fact, for the world economy,
right.
you should be allowed to keep your job for
Right. But you have exactly the point that there are ways to use this aging society to the advantage.
If I could just throw in one thing. This is something that Vince mentioned, which I think is important here, which is if you actually look at who among the older groups that are dropping out in the US, it's primarily people with relatively low skills. And so part of the challenge here is, for people that frankly do reasonably well, that's not really the issue. The issue is frankly older workers that don't have skills that sort of line up well with how the economy is evolving. And that is a very difficult challenge. And so I very much agree with the notion that we should try and, in some sense, keep people in as long as we can. But that does not get us around the fact that a very simple way to think about it is, are you a substitute or a complement for a computer? If you're a substitute for a computer, this is a bad world for you. We need to have more people who are complements to computers, but that's not an easy thing to do, and it's particularly not an easy thing to do among older workers.
And it's also related to some of the other challenges we have as a nation. The differential skills gap implies increasing income inequality. Since those high skills are usually associated with capital, it also probably means a declining labor share of income. So that this is a serious challenge we got to address.
Yeah, go ahead.
Hi, it's John Macon, American Enterprise Institute in Cornwall Capital. I have a comment and a question on the participation rate, Vincent. I think that the Fed has encouraged the participation rate amongst elderly workers by driving the return on alternative accumulated wealth to zero, and thereby forcing them to go to work or take risk. But my question is this. I think the Morgan Stanley forecast for the first quarter is intriguing. That suggests that sometime in April we'll be reporting numbers that suggest that growth is below 1%. Meanwhile, the Fed is blissfully predicting 2.5% to 3%. My question to you is this: will we see the development of the Yellen put in April or May, should the economy and the markets respond negatively to a sharp slowing? That is, will the Fed alter its path of policy?
Right. So first, as a point of fact, it is certainly true there were more letters of complaint into the Fed about low interest rates than high interest rates, and it came from savers. But the Fed also helped foster an enormous increase in equity values that have made people wealthier and made retirement plans more assuredly sounder. So that part is mixed. Our forecast, it's really a tracking estimate of GDP. It's just how do you add up the numbers that are coming. We think that fourth quarter GDP will be revised down to 2.5% growth, and that first quarter is tracking something about 7/10. That does set up the Fed for what's happened in the previous 4 years, serial disappointment, start with a high forecast and then have to move it lower. I think the first point to note about that, as opposed to prior years, they've already have momentum on their major monetary policy initiative tapering, and it would be a while before they would probably slow that process if that forecast came true. If in fact growth stays low, then Janet Yellen will push out on the data first policy tightening. She'll try to convince you through forward rate guidance that there's no need to raise rates anytime soon. And having said that the tapering decision is data dependent and made meeting by meeting, they may have to stall out the tapering just because if they're shamed by the data. That's not our forecast. We think that we are in the process of moving up to a 2.75% growth channel that in line with that 7/10 weak first quarter is a good sized rebound in the second quarter. But the Fed's going to be challenged. But I would actually think Janet Yellen's life is easier with a little slower data at the beginning of the year. Why? At this stage of the monetary policy cycle, the hardest thing for a central bank is to push out against market participants getting ahead of themselves. Coming to expect data that expect interest rate increases that are sooner and more aggressive than is consistent with sustaining economic expansion. I think the Fed would, if you think about it, in December and January, we had misses on non-farm payrolls of 120,000 and then 70,000. If those had been positive misses instead of negative misses, that is non-farm payrolls of 310 and then 250, Janet Yellen would have a lot of trouble now pinning the front end of the yield curve, convincing people not to get ahead of themselves.
Let's go the question up here.
Evelyn Leopold, a journalist at the United Nations. Could you kindly discuss the long-term economic and social implications of youth unemployment, both in this country and in most European countries except for Germany, where they do have an extensive apprenticeship program? And attached to that are discussions now of raising the minimum wage. Does that make any difference, or should people who can't pay a living wage go out of business?
I'll start off. First of all, I'm an economist. The broad context of that question, I'm not competent to address. Look, there's a lot of research that's been done about the impact on lifetime incomes of essentially people beginning their careers under adverse labor market circumstances. So I think there is a very real concern at this point that the young people who are coming onto the labor market now, who are having trouble getting their first job, there will be permanent effects for them of that consequence. And I think that is part of the reason, to be quite frank, the Fed has been so aggressive in trying to get better labor market outcomes. The problem is, what are the limits of that? And I do think part of this thing that Vince and I have been talking about in terms of long-term, where is potential output, are related to those potentially permanent problems. I would note that a lot of the research that's being done in the US about things related to this now, in some sense, follows on research that was done first in Europe. And so we are seeing, I think, more similarities in that area between our experience here and what you've had in Europe. So look, this is a big problem, and it's one where I think, unfortunately, the degree to which you can address it with the sort of the blunt instrument of just let's generate more aggregate demand through monetary policy, we're going to have a debate about what are the limits of that over the next year. And to some extent, if you're going to have to address it another way, you're going to have to find other policies. Quickly on the minimum wage. There is a sort of an active debate within the research community over how big the effects are on employment. I tend to come down more on the micro evidence that suggests those effects aren't that large. I would note that this is one small part of a much broader problem, right? One of the things that is striking when you look at the income distribution problem is how broad it is. So one of the things which is I think quite notable is if you look at median incomes by education level, I think before 2000, those had been sort of widening. So the median income for people at the high end, for this sort of college education, had been rising relative to a high school education. That's actually changed since 2000. The median income for the most highest educated groups has actually been falling. And what's striking is what you're seeing is a greater and greater concentration of wealth and income at the very highest levels. And so, and the minimum wage is going to address part of that, but it's a much bigger problem.
Anybody else want to comment on youth?
I think the youth unemployment problem is a reflection of the mismatch of skills and that young workers can offer, and the firms are looking for. And this is related to the computer substitutes complement problem, but the educational system has to be adapted to the new world of globalization and IT world to educate properly the young people. And I think Europe is failing to do that. Japan is failing to do that, and US, I'm not sure, failing. So I think those more vocational training is probably good, and more changing those emphasis on the general education or the liberal arts should change.
So I think one thing the U.S. is very good is generating variance. That is, our education system it has a very high variance. Why is that actually good? It means, well, okay, there's a low tail, and that's the part of us where we're not delivering skills to the young people who need it. It also means there's high skills, a high tail. That's the technological innovation. That's our top tier universities. That is why you shouldn't bet count the United States out as being able to generate total factor productivity. Uncharacteristically optimistic.
Let's have a question over there.
Thank you. Laetitia Guerrier at Ajna Partners. Back to Japan, past the impact of the tax hike, for which there are clear levers to sort of offset, and into the spring wage negotiation, can you help us understand the lay of the land of the key actors that you see influencing this process? And obviously, you know, for the sustainability and virtuous circle of Japan, we all hope to see wage inflation. Can you help us frame this?
Right. So the wage in Japan has been declining for at least 10 years. And that was consistent with the prices going down. So we want to change it, both prices and wage front. And success of the first arrow is that Abe clearly indicated that getting out of deflation is the first priority, and now and Governor Kuroda is very explicit on achieving 2% target. So yes, prices are going up, and it's on track, and probably will reach 2% inflation rate in a year or two. Fine. Now wages have the inertia, and since it has been going down, there is a force to still going down. But the government is now putting out a lot of efforts to convince the large corporations to raise the wages. So this is not the wage increase, which is not justified by productivity gains or the inflation, but it is to go along with this inflation targeting, at least to keep the real wage constant. Of course, the companies vary. That some companies have large profits who can afford to distribute to labor. There are companies who are suffering still from the high yen period and with their own problem. So it won't be uniform increase, but I'm sure that higher profit companies are willing to go along with the government that yes, this is the time to increase wages. So this can be contrasted to the earlier experiment in the early 1970s when the inflation rate was high, that we all wanted to lower the inflation rate, but the key was to lower the wage. So try to convince the unions to restrain from asking for the high wage increase just because inflation expectation was high. So this is reverse of that. We try to promote the inflation expectation to go up, and to go along with it, wage inflation is important. So I think this effort is well grounded, and this effort will succeed.
But so Taka, between 71 and 74 in the US, when there was this attempt to politically manage incomes policies, it didn't work. You think in Japan, it's a different kind of society, so when the government tries to persuade the private sector to change wage settlements in response to its inflation target, you think Japanese society will respond to that better than the US did in the 70s?
I don't think it's a society or culture. I think it's just a fact of economics that there are companies who have done extremely well despite yen appreciation, and with their own cost cutting and other belt tightening, that they can't afford to distribute to the labor. And they have the huge cash. And we're asking, what are you going to use this cash for? Investment or dividend or wage increase? So it won't be a hardship or distortion that they distribute to the wages, especially when they're convinced that inflation is coming.
And there might be an asymmetry of trying to talk wage growth down versus talking wage growth up.
Sure.
So I'm not sure the Richard Nixon episode is necessarily determinative here.
Good. Okay. In the back. Come to Roger.
Xinhua. There seem to be two forces. The one is emerging market volatility, and the other is economic growth in some developed economies are strengthening. So which one will outweigh the other? And does that change your prediction on world economic growth in the year? Thank you.
I didn't quite get that.
So our forecast for the U.S. is conditioned on a global economic forecast that's nested within that, and within that is a important stabilization in emerging market economies. Some emerging market economies will find it difficult to weather increases in U.S. interest rates, but we think that is contained enough. And at the end of the day, it really is, will China continue to grow at a robust rate? If that's the case, then that will support the advanced and emerging market economies along the Pacific Rim levered to China. It will keep commodity prices well maintained, and it will be a backdrop that U.S. firms will decide to add to capacity. So you are right. Our forecast depends on emerging markets, and within that it says most will be able to weather the backup in rates, and that China finds a point where they can offer society a little bit more financial stability but steady growth.
My friend in Washington, I'm quoting a friend in Washington that when emerging market has a boom, both the smart money and dumb money goes together and in a euphoria. But when money comes back, the smart money comes back first. And so the point is that this emerging market currency depreciations, it is discriminating that really emerging market economies with fundamental problems had depreciations, and relatively sound emerging markets still hold. So I don't think it's right to blame the FRB or any others, but they have to fix their own problems.
So the Indian
That includes China, I think.
the Indian central bank governor Raghu Rajan, who is blaming the Fed for destabilizing the Indian economy, is essentially
That's for domestic consumption.
dealing with his domestic politics. Okay, good. Well, on a political note, we'll end it there. Thank you very much to all the panelists, and thank you for coming.